I have a lot of clients call me when it's time to get themselves approved for a loan, very overwhelmed because they have no clue what paperwork they need to provide for the lenders. But don't fear, because this is every single document you'll need to get a loan. Firstly, the bank's going to want to identify you. So you're going to need to provide either your driver's license, state issued ID, or your passport. Next, the lender's going to want to pull your credit and report the mortgage to the IRS. And in order to do this, they're going to want to request your social security number. If you don't know your social security number, you can either try texting one of your parents or go to ssa.gov to find it. Now let's get to the juicy stuff, pay stubs. Essentially, the bank wants to prove that you're earning what you claim. Specifically, they're going to be looking at your year-to-date earnings and comparing it with your stated salary. For example, if you claim you make $60,000 a year and it's currently July 2nd, they're going to want to be seeing around $30,000 in pay stubs. And if you have any other reliable extra income, lenders typically want to see a 2-year history when it comes to extra income like overtime or bonuses. Next, you'll need to retrieve your last 2 years of W-2s or 1099s and your last 2 years of tax returns. And if you have any brokerage accounts, you're going to want to provide those as well. Now, if you're self-employed, you're going to want to provide not only your personal, but also your business returns as well, and your year-to-date profit and loss statements. Okay, this next step is optional. Banks are going to require it depending on who you are and your personal financial statements. For some people, they need to prove that they're a lower risk borrower for the bank. This is why the bank's going to want you to provide them with statements on all of your financial assets. This includes all cash, savings, brokerage accounts, CDs, checking, savings, retirement accounts, literally everything. All of these accounts are what's called your reserve funds, meaning if you for whatever reason lose income, these are looked at as your safety net. All right, moving on. Let's move on to one of the most important things, debt. Lenders want to measure how much of your monthly income is committed towards paying off debt. They do this by calculating what's called your debt to income ratio by using this equation. Lenders typically want you to have a DTI of less than 43 to 45%. Okay, lastly, let's talk about residential history. Lenders are going to be looking for a stable housing track record. If you rent, they're going to want to see that you've been paying on time consistently. Time's running out of this video, so let's speed run the rest. If you currently have a home and a mortgage, you'll need this. If you have a home and have full equity in it, you'll need this. And finally, if your current home is under contract, you'll need this. I'm Aiden, a licensed realtor based out of Atlanta, Georgia. If you're looking to buy or sell anywhere in the US, I work with a network of top performing agents, aka professionals who are personally vetted based off of experience, professionalism, diligence, and client satisfaction. So if you want to be connected with one of those agents in your area, shoot me a DM and I'll make sure to connect you to one of those agents.